Today I would like to analyze Hermes, one of the largest luxury companies in the world and one of the worst performing stocks in the last 6 months. The stock price is down around 23%. In the last 5 years, the stock is up around 191%. So we're going to take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is a market cap of 223.13 billion euro. We can see here this makes Hermes the second largest luxury company in the world by the market cap. We also have a dividend yield of around 1.24%, which is quite small, but we can see here we had a very good dividend growth rate in the last 10 years. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So in 2020, the revenue was around 6.39 billion euro. This was a 7% decline from 2019, so probably related to COVID. Then in 2021, we had a strong comeback with a growth around 40%. Then in 2022, we had a very strong growth around 29%. In 2023, we had a good growth around 15%. And then in 2024, we had a good growth around 13%. So I think in the last 5 years, we had a very good revenue growth. So it's a check here. The next thing we're looking for is the free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 1.31 billion euro. This was a 23% decline from 2019, so probably related to COVID. Then in 2021, we saw the incredible growth around 129%. Then in 2022, we saw the very good growth around 25%. In 2023, we saw the decline again around 0.53%. But then again in 2024, we saw the good growth around 8.59%. So overall, I think in the last 5 years, we had a very good free cash flow growth as well. So the check here. Even though we had the free cash flow decline in 2023, we can see here the operating cash flow increased around 3.44%. So this is something positive. So the reason for the free cash flow decline is that the capital expenditures increased in 2023. It means the company investing more money into the business. The next thing we're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for an undervaluation. So we're going to take the free cash from 2024, 4.07 billion. We're going to divide it with the current market cap, 223.13 billion. And then we're going to get the free cash flow yield for 2024. This is around 1.82%. So in my opinion, it's a small free cash flow yield. We would like to see that over 4%. So it's not a check here. We can also calculate with future assumptions. So in 2025 is assumed to have a free cash flow around 4.04 billion. In 2026 around 4.73 billion. And in 2027 around 5.31 billion. So let's assume for 2027 5.31 billion. Then we're going to get a different free cash flow yield. So we're going to divide it with the current market cap as well. And then we're going to get a free cash flow yield for 2027 of free cash flow assumptions. So the number we're going to get would be around 2.37%. And still, in my opinion, a small free cash flow yield is also not a check here for 2027. And in my opinion, already an indication for an overvaluation right now. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with the free cash flow in under 5 years. A very important number, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. We can see here around 0.06 billion. Then we're going to add the short-term debt as well. So the short-term debt is 0, so we don't need to add this. Now we're going to divide it with the current free cash flow, 4.07 billion. And then we're going to get the ratio that we're looking for. So the number we're going to get would be very low actually. So around 0.014. And I think this is a very good number actually. It not takes many days to repay the debt with a free cash flow. So it's a check here and we really like to see that. We can also take a look at the cash on hand, how much money this company has in the bank, and actually a huge amount as well, around 11.64 billion. So overall, I think this company has an amazing balance sheet and we'd like to see that. The next thing we're looking for is an enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. So lower the number gets, the higher the indication for an undervaluation. So now we're going to calculate the enterprise valuation first. So this is the current market cap, 223.13. Then we're going to add the debt as well. So this is around 0.06 billion. Going to take minus the cash, 11.64 billion. And then we're going to get the enterprise valuation. So how much the whole company is worth. This is around 211.55 billion. So now we're going to divide it with the current free cash flow, 4.07 billion. And then we're going to get the ratio that we're looking for. So the number we're going to get would be around 51.97. And in my opinion, it's a huge number. We would like to see that number under 25. So it's not a check here and it's already an indication for overvaluation. We can also calculate this number for 2027 with our free cash flow assumptions of 5.31 billion. So then we're going to get a different number, and the number we're going to get would be around 39.83. And again, a huge number. I think overall is also not a check here, and we can say this is an indication again for overvaluation right now. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially if we think the company is undervalued. So we're going to take a look here, and we can see in the last 5 years this company didn't really do much buybacks. We can actually see the stock outstanding increased a little bit over the time. It means they put more shares on the stock market. So it's not a check here, but in my opinion it's not necessarily a problem. Is Hermes stock a good buy right now? One of the worst performing stocks in the last 6 months. The stock price is down around 23%. So let's start with a positive about this company. I think we had a very good revenue growth in the last 5 years. I also think we had a very good free cash flow growth as well. And this is something very important to me. The balance sheet is also looking great. So we have a low amount of debt and a good amount of cash on hand. The free cash flow yield around 1.82% is quite low in my opinion. We would like to see that number over 4%, and even with the free cash flow assumptions of 2027, the number is slightly better but still quite low, around 2.37%. The enterprise valuation to free cash flow ratio around 51.97 is also very high in my opinion. We would like to see that number under 25, and in 2027 with our free cash flow assumptions, this number looks slightly better, around 39.83, but still very high in my opinion, and it's an indication for overvaluation right now. I think this company trades as a premium valuation at the moment, and I think is still overvalued right now. If you found this video helpful, don't forget to like and comment and subscribe for more content.